Since World War II, sort of value investors conveniently ignored the macroeconomic situation and gone about, doing very specific company by company analysis, trying to understand whether this company was cheap, this company had a margin of safety, but they didn't actually understand that, there was really this kind of credit impulse or credit growth that was going on, between 2003 and 2006, i.e. the US housing bubble, and the kind of investments that you got all over the world that was actually driving a lot of the earnings and the earnings numbers, let's say in the financial institutions, i.e. the US banks, and that none of these credit impulses were actually sustainable. Value investors who had done all their analysis thought there was a margin of safety, given earnings or given book values or whatever, were completely blindsided by the fact that a lot of those earnings or a lot of that book value was in effect just fiction the minute that housing crisis came about. We recognize that actually the most important determinant of the return to a portfolio is really the asset allocation. What drives those returns is what is the sort of economic regime. So certain assets do well in an inflationary environment, certain assets do well in a deflationary environment, and certain assets do well in a sort of a normal economic environment. What actually led us to the Austrian school was to sort of try and make a distinction between different assets, what asset classes would actually do well in what kind of environment. What we have been stressing over the last few years is that we are going to get some sort of an extreme economic environment. So by that we mean very likely that we're going to get inflation or deflation, and if we are really unlucky, we might end up with both inflation and deflation. Prudent investors should allocate 1/3 of their assets to different types of environments. So we say, well, put 1/3 of your assets in assets that will do well in inflation. Put 1/3 of your assets in assets that will do well in a deflationary environment, and then put 1/3 of your assets in asset class that does well in a moderate economic environment. So for example, during inflation times and inflationary times, obviously commodities do well. Companies that represent commodity companies actually do well. The inflationary episode that we had from 1971 to 1982, gold went up by 20 times. Now, I also happen to believe that people mistakenly think that gold only does well in an inflationary environment. It actually also does well in a deflationary environment. And the reason is very simple. In a deflationary environment, although gold holds its nominal value, all other asset classes, go down by anywhere from 70 to 90%. In real terms, actually gold appreciates by almost, a similar magnitude of about 10 times. And the reason is that gold is the only monetary asset that doesn't have, any other liability as its counterpart. So the point is that, understanding the macro environment is a very, very important component of understanding how, an asset allocation should be tilted, because that macro environment is going to determine how, asset classes do in a particular environment. That is a very conservative, prudent way of dealing with the fact that there's a lot of uncertainty. A lot of that uncertainty emanates from the fact that we don't quite know how extreme central bankers' reactions is going to be. And so the prudent way actually is to sort of, have a 1/3 sort of approach in terms of your, sort of, your asset allocation. So what we believe is that you should actually be invested in the highest quality spectrum of each of these asset classes. The highest quality cash or liquid instrument is gold. The highest quality fixed income instrument is, liabilities issued by net creditors. Or in the absence of finding net creditors, for example, in India, you don't have net creditors that actually issue debt liabilities. You need to find entities that have very strong cash flows, that have very sound business models, that no matter what the circumstances are, will continue to provide a service, provide a product that people need. And then finally, in the equity market, you need to have equities of high quality businesses. They could be cyclical, they could be defensive, but essentially they are businesses that have high return on capital employed over a full cycle. They have strong cash flows, strong free cash flows, and essentially their balance sheets are sound. So what we believe that no matter what, no matter how difficult an economic environment you end up with, these companies are going to actually survive and thrive. And again, even though we are stock pickers and equity specialists, we really believe that 80% of the returns are actually driven by the economic environment and the asset class rather than the specific stock picking skills that you actually bring to the table. This monetary arrangement is not just dysfunctional. In the next 5 years, 10 years, this monetary arrangement is going to change.
So what we believe is that there are essentially two kinds of parameters that should be used to identify if a company is of high quality or of low quality.